We're here with Professor David Yermack, a colleague at NYU Stern, who chairs the finance department and also leads our fintech specialization, and is also our first three-time guest. So congratulations, a nice moment for you.
It's an honor.
Okay, what a thrill, right? So David is our resident expert on crypto and blockchain. Give us an update on what's happened in the market over the last 30 or 45 days.
You've seen a general rise in the market. Bitcoin is now flirting with the $10,000 market price again.
What was the low? It went down to 6,000 or 5,000?
Yeah, it's risen about a third since earlier in the year. It's, you know, if you had bought it, say, at the end of January, you have a really nice profit on your hands for the last 3 months or so.
Yeah.
And we've had a lot of regulatory activity that has gone on in Washington with the SEC thinking about exactly how big of an umbrella they want to try and fit over this space, how much of it is really covered by the securities laws, and something of a turf war with the CFTC, which wants to regulate these things perhaps as commodities under certain circumstances. So regulatory clarity has been a long-sought goal of almost everybody in the space, and we're seeing at least some movement in that direction, but it's far from certain what the courts will think of this when inevitably there's litigation, and ultimately Congress will probably end up having to write new laws to cover what's really a new type of property.
And we also saw Goldman has made some big announcements around crypto, right?
They intend to trade some private futures that will be a type of derivative, and I think really many of the big asset management firms are getting enough inquiries from their clients that they're looking for ways that they can offer these products without going over tripwires on the compliance side that might implicate some of their other product lines. But I think you're seeing a demand-led entry of some of the bigger players on Wall Street who are trying to meet the needs of their customers by offering these in different portfolios, different derivative forms, and so forth.
And probably the biggest news was Buffett and Charlie Munger. And how do they feel about Bitcoin?
They don't like it, and they've been very consistent over time at finding increasingly pejorative language. At the Berkshire Hathaway annual meeting, Buffett said that owning Bitcoin was rat poison squared.
Squared, that's the key.
And rat poison squared. And Charlie Munger said that trading cryptocurrencies is just like dementia. And they don't see much of a role for this. Buffett has always said that he doesn't like to invest in what he doesn't understand, and it seems that he's sticking to that with the cryptos.
But they're comfortable commenting on what they don't understand.
Yes, they're comfortable trashing it.
So talk to us, we were talking a little bit about some of these new coins and what some of the developments there.
One of the more interesting classes are the so-called stable coins, where people are trying to create coins that replicate real assets or real currencies in the economy. So there's something called Tether that's been in the market since the middle of last year, and a Tether is supposed to keep a fixed value of $1 per Tether. And there's another one now called Basis that has a similar objective. It wants to be stable, really as a substitute for the US dollar, but a somewhat different trading strategy in the background that's meant to keep the value stable.
So buy it when it comes below $1, sell it when it goes above $1, and just keep it. It's almost like the Bank of England trying to support the pound at a certain level.
It's exactly what central banks do to try to peg the value of their currencies to one another. So you may remember a few years ago, the Swiss central bank put a ceiling on how much the Swiss franc could rise against the euro. For years, the Hong Kong central bank has pegged their currency to the US dollar.
Doesn't that always end poorly?
There are famous episodes like in Argentina in the 1980s and 90s. They ran what was called a currency board to try to fix the Argentine peso to the dollar. Eventually, you run out of money.
To support it,
Yeah, if you make a commitment that we'll buy as many as we need to, sooner or later you need to buy more than you can afford, and these things tend to collapse and end rather badly. Now, the guys at some of these crypto coins, and there's actually quite a few of the stable coins now, they claim to have algorithmic strategies that will execute themselves automatically. And I think these things often work under normal market conditions. But when conditions get extreme, there's a lot of volatility, a lot of underlying movement in the market. That's sort of when you need the stability the most, but when people are least likely to be able to afford it. So it's far from clear. We'll need a long period of time to see if these things really can hold their value. But this is the marketing pitch, that they see a need for these kinds of tokens to provide liquidity and just a benchmark for other things to go against in the crypto economy. And so there's been a lot of enthusiasm for this. Some people are trying to tokenize gold, or you could think about doing this even for shares of stock or many other currencies besides the US dollar. So this might turn out to be an interesting market space where you can replicate existing assets but get out from under the ordinary regulatory burden that comes with owning and distributing them to customers.
So if the interesting thing you said there was that it would be like the dollar, but skirt the regulatory hurdles you get from transferring dollars. Does that mean you don't have to report to the IRS, so there's no red flag when you deposit $10,000 somewhere else, or you send $1 million offshore? What does that mean?
What your obligations are to report is very much a gray area, and there are lots of different points of view. I think there are existing laws that certainly could be interpreted in one country or another that you would have reporting obligations. But I think the attraction in many of these assets is that either people believe that the authorities can't see them or won't take an interest in them, or that in fact they're so different from the underlying thing that they're trying to mimic that maybe the same obligations don't kick in. There's a lot that the regulators are going to have to do to catch up with this. It's very challenging, not just in Washington, but in every capital around the world, that you have a new form of digital instruments that just don't fit well into the securities laws or the banking laws or the tax laws. And even if you could write laws that capture these things, the way you chase them down in these virtual forms that they take and the way you might enforce laws against them and punish the people in charge, it's very difficult to see how that would work the same way, because this stuff doesn't exist physically. It exists in the cloud in virtual space. So I think if you're looking to move money around the world and not see regulators knocking at your door when it exceeds $10,000, this is one alternative that might attract some people. Could also attract terrorists and all kinds of other people who want to move money without being detected.
But isn't it one of the sales points of this thing that it actually should do away with crime because it's all ledger-based and should be pretty traceable?
I think in theory this is correct, that you've actually got a blockchain that is a record of every transaction ever, and this makes it really quite hard to hide, that your whole history is there. Even if today they don't know what you've done or who you are, they have all the time they need to kind of try and invert this and figure it out. But I think you're going to see an arms race between cryptographers who are selling anonymity in the form of blockchains that have super encryption and these zero-knowledge proofs and various other features. And you'll see consulting firms go into business to try to unravel these things and deliver up to the authorities who really is controlling these wallets and who's really moving the money. I think, clearly you've already seen the opening of an arms race in this little corner where some groups think you can use this technology to hide. Other groups think it's kind of a trap that the government can lure people onto these platforms and then see exactly what they're doing. There is kind of a high road and a low road. You see a lot of people doing voluntary compliance and just putting up their hands and saying, we agree we're securities, show us which box do we check.
Along those lines, initial coin offerings, you say there's a flight to quality.
There have been more than 2,000 ICOs since the beginning of last year. Half of those never got off the ground, and so there's a lot of them go very quickly to zero. But some of them have been very successful and raised hundreds of millions of dollars. And they are now investing this money to develop platforms that may eventually deliver things like decentralized storage that is in great demand. So of the tokens that are out there, some have been very brazenly non-compliant. They've ignored the law, and some of them even just kind of look like Ponzi schemes on their face. But others have done quite the opposite, and they've tried to put structures in place that resemble what venture capital and other forms of entrepreneurial finance have done.
Disclosure, risk, all kinds of, basically, almost like putting together a prospectus.
It's like a prospectus. They call it a white paper, but the structure that people are using that seems to have the most regulatory credibility is called the SAFT, the S-A-F-T, or Simple Agreement for Future Tokens, which resembles something called the SAFE, which is for future equity, that has been used in venture capital for some time. I'm not sure if the SEC ultimately will give this its blessing, but I think it represents a sincere attempt by the industry to get on the good side of the regulators. And often it's really voluntary compliance, that people who are trying to get credibility for a new type of asset, they find it in their interest to work with the regulators and to seek the high ground and to try to pay their taxes and disclose everything that should be disclosed, because in the long run, people probably don't want to invest in something that doesn't have that kind of credibility. So this is a very early stage of a market that is not even maturing yet, but maybe going through adolescence. And you are seeing segmentation, and there are people going for the high ground and people going for the low ground, and a lot of confused people in between. But I think one thing that's true about these coins, the tokens, they're not going away. This is a real innovation that's quite interesting, and people are being able to raise large sums of money rather quickly.
That's a statement right there, because at one point about a year ago or 6 months ago, it felt like there was a non-zero probability ICOs could just get shut down as pure fraud.
Right.
You think it's here. You think it's a financing vehicle that is going to be around for a while.
And like I said, there have been 2,000, and well over half have been worthless rather quickly.
What percentage are not, if you use the term broken IPO, what percentage are not broken ICOs, where they actually have worked as financing vehicles and they have some value 3-6 months post the issuance?
At this point, I would say about 20% based on data that I'm working with. Now, that's not to say that many of those 20% won't themselves fail in the next year or two, because this is characteristic of all startup businesses. And I think the right benchmark is not that you should expect all of these to return a profit. These are very risky ventures. Think about, of all the restaurants that open in New York, how many are still open in a year? What's the failure rate for new restaurants? That's really the kind of benchmark you want to think about, is for startup businesses.
Yeah, or even, you're exactly right. It's not, the benchmark isn't the percentage of successful IPOs, it's the percentage of venture-backed companies even going downstream into angel, or maybe it's 1 in 10 or something like that.
IPOs are the ones who get all the way to the 8th inning.
Most of them are already winners. Yeah, so if an ICO, or talk to us about, can an ICO just be a financing vehicle, or is it strictly the domain of companies that are building something related to the blockchain? So you had a great company and wanted to avoid venture capitalists. Could you do an ICO, or does it have to directly be linked, does a capital raise have to be directly linked to innovation around the blockchain?
That's really what an ICO is something linked to a blockchain, because it is a token giving customers the right to use the product once it's completed in the future. So it's a way to raise money from your customers rather than
a Kickstarter thing, right?
Yeah. And it's really a new channel that historically people raise money by selling ownership that we call equity, or maybe from borrowing it from a bank, which we would call debt. But this is not debt, it's not equity, it's a new type of financing where your customers invest, and if the value of being a customer goes up, they will profit as well. But it's really the utility of using the token to access whatever the service is that is the source of the value. It's not a dividend or an interest payment or even a capital gain necessarily.
No ownership, no governance, nothing like that.
Yeah, the definition of a security from an economist is you get cash flow rights, like dividends, and you get governance rights, which is typically voting. And you don't get either of these with a token.
Why wouldn't Tesla do this? Instead of taking cash up front, why wouldn't Tesla have a coin that says, for this coin, this is the Tesla Model 3 coin?
I wouldn't rule it out, and you do see business models where people pre-sell their product before something is built. So cruise ships will sell tickets to the cruise before the boat is launched. Football stadiums are built this way all the time, where personal seat licenses are sold before the stadium is constructed. And you're tapping into your customer base as a source of finance in exchange for them getting the gain if the experience of being a customer turns out to be more valuable than people expected. So, why doesn't Tesla do this is kind of a good question for Elon Musk.
But that's not related to the blockchain. That's just a financing vehicle. So you do think we'll see coins that aren't directly related to building out the blockchain?
The blockchain is where these things are hosted and traded. And I think
that's the exchange.
Yeah, one thing that you need is some controlled scarcity. So most of these tokens are created by way of smart contract, where you can make a credible position or credible commitment through the software that you won't create more tokens and dilute the ones that are already out there. So in terms of a football stadium, you don't want more personal seat licenses than there are seats. And in terms, if Tesla were to do this, they'd need to make some commitment that there wouldn't be more Tesla coins than cars. And one way to do that, in fact, is to host them on a blockchain where the issuance protocol is very transparent. And so if they actually tried to dilute the market, you would be able to see it happening and complain.
But what additional guarantees? I serve on public company boards. We can issue additional stock with the board approval, and granted the stock might go down because an analyst will say this, or your stock's about to become diluted. But why do coins necessarily, is it a trust thing to come out of the gates and say we're going to tie this to some sort of finite or limiting mechanism? Because you can issue more stock, a company can issue more stock.
It's not so easy with these tokens because they are in the form of smart contracts. And what this is a computer program that contains all the constraints and variables. And one of the things that appears in every token smart contract is a limit on how many there could ever be. Now, you might get clever and say, there can only be 1 million of these tokens, but then I'm going to create
a new token.
Alpha token, beta token.
Model X token.
And this is meant to be a perfect substitute, and we'll create another. And would they really be valued in the market? Would they give access to the same platform and replicate the first token? I'm not so sure that they would. So the scalability and replication of tokens, you really haven't seen anybody try this yet because these platforms are all years into the future. But it is often remarked that the governance of these things and the enforcement of the smart contract terms may end up to be the weakness, the Achilles heel, if people can do as you conjectured. We'll have to see if there are shady people and companies that are able to program around the constraints in the smart contracts. You do see this in the debt markets where there's covenants against future borrowing, but people find ways around it by issuing new debt of more junior grade or whatever.
Blank security. So the first 6 months of 2018 versus the first 6 months of 2017, number of ICOs, capital raised, stability of the market, how does it look year on year?
Vastly more capital has been raised. That ICOs at this point last year were still a novelty, and you were just starting to see the beginning of the wave. But we're now into a market that is, probably going to raise somewhere between 3 to 5 billion in the first half of this year in ICOs. And there have been hundreds and hundreds of new issues. You also, a year ago, didn't have the beginnings yet of the big run-up in the crypto values. The big march from about 2,000 to 20,000 in the value of Bitcoin was mostly something at the tail end of last year. We had then something of a collapse in January, but now, really a 3-month rally in February, March, April, and so forth.
So whenever you see this sort of adoption, it usually indicates that the incumbent got greedy and had fat margins and was sticking its chin out. Is the backstory here that investment banks with 7% fees on IPOs and venture capitalists with extremely costly forms of capital, isn't this basically, doesn't the ICO market, if it ever becomes legitimate, essentially say that banks and venture capitalists got greedy or fat and weren't adding the value that their fees justified?
I think that's exactly right. People have been looking for an alternative source of entrepreneurial finance. Going public through the equity market's extraordinarily expensive because you have the 7% commission, but you also have the tendency to underprice the shares by 10% and very, very high compliance costs to meet the requirements of the SEC. So I'm not sure that the investment banks are all alone in this, that a lot of people have thought that the several rounds of regulation, the Sarbanes-Oxley and Dodd-Frank laws and so forth, they've made it so onerous for a firm to list itself publicly that we've observed IPOs vastly reduced. IPOs have all but stopped over the last decade in the US. And you're seeing firms like Uber and Airbnb really indefinitely staying off the exchanges when ordinarily they may have gone public in the last generation.
So could Uber offer a coin that says, could you have an Uber coin that says unlimited free rides to this individual and the blockchain just tracks your identity to make sure you're not abusing it? And
biometrically with your fingerprint.
Right, because I spend $1,000 a month on Uber, $12,000 discount, cap rate of 5. So what is that? That's 200. I mean, that's a $250,000 coin supposedly, right?
I would think that a lot of these fintech companies, especially the ones in the peer-to-peer markets like ride sharing, might find it very appealing to have their own currency. It's even suggested that Amazon might put Amazon coin out there, because they're increasingly.
But it sounds like it needed to be a prime coin because you'd want to directly link to something that you could value, wouldn't you?
Yeah, but they've got all these retail platforms now with, they were originally a bookstore and now they've got Whole Foods and everything in between.
What I don't understand there, Professor Yermack, is if I buy an Amazon coin and I can't have ownership, I'm getting the rights to the future product, does that mean I get unlimited everything from Amazon? You'd have
That's
to bound
up to
it,
Amazon.
right?
Yeah, they might just give you priority as a customer, to think about
Prime.
Yeah, Prime.
The Prime coin.
The airlines could do this and sell elite status or
Right.
gold status and so forth. I think that you're going to see some innovation in the business and revenue models, and that for the very big media companies, having their own currency, especially since they're multinationals, might be very
It just
attractive.
feels like it's so ripe. It seems to me you want to attach it to a recurring revenue charge stream so people feel like they can value it. So Netflix feels perfect.
Yeah.
Spotify coin feels perfect.
I gave this as an exam question in a course last year. Should Amazon issue Amazon coin? And there are various pros and cons, including the fact that Amazon has a big footprint in the U.S. markets and issues equity and wants to keep the SEC and the IRS happy. If they saw this as a method for tax evasion, it might get them in trouble in their mainline business.
So you're involved in the joint program with the law school.
Yeah.
If you were advising a kid who was platform agnostic and was an athlete, equal skills across all dimensions, and was just an economic animal, would you say the sweet spot over the next 5 to 10 years is to be an entrepreneur leveraging on ICO, to be a crypto miner, to be a lawyer putting together these white papers, selling picks to the miners? Where do you think on a risk-adjusted basis the best place to play is if you're young and your most valuable asset is your human capital and you want to make an investment in this space?
I think all the things you listed are possibilities, but the lawyers are going to be very busy.
Yeah, it feels that way.
I had underestimated the need for lawyers, although this is why we started our course, was to train lawyers to help write the regulation. But it seems like there are so many novel legal questions that you see the law firms starting up big crypto blockchain practices. So I think, if you want interesting work at the cutting edge, going to law school to learn to be a blockchain lawyer is a pretty smart career choice. And I do think that the hardware is a big opportunity, that faster mining machines are really, really valuable, and I don't expect the demand for these to go down anytime soon. There's a really funny story in the news yesterday about a bunch of mining machines that were stolen from Iceland, and then they resurfaced maybe in China, where people had taken them to hook them up to an illicit power source where they disconnected the meters so that they weren't paying for the electricity. But this is the kind of stuff that bank robbers do to get the stuff out of the country into a safe haven. And if you have an innovation in mining hardware, you could get quite rich, although the half-life of these things is maybe 18 months at most. But still.
The half-life of the technology.
Yeah, the technology is constantly being improved upon. But to be part of that innovation, I think there's a lot of value added, and you would have no trouble finding work. In fact, you would probably start your own firm and try to market the stuff yourself.
But isn't crypto mining similar to petroleum in the sense that the refining equipment is costly, but it's largely been commoditized, you have access to it, that the cost of the end is the oil, which is electricity?
No, you're still seeing a huge J-curve in terms of the productivity and the technology coming down in cost. This will eventually plateau out. That's why you think of it as the shape of a J. But for now, the comparative advantage is really the hardware. And the hardware can be energy efficient, if it saves you on the electrical bill, or if it doesn't get overheated, or if it just can do the computations more quickly. Any and all of those things can be a comparative advantage. There's intense interest when new mining machines come onto the market. And some of the coins, there's actually been controversies about maybe we should reprogram the code to keep these new miners off of the chain.
So how do you play that? I know NVIDIA is one way to play that, but who sells into the tech that you can make money off of?
I think a lot of the big IC chip makers are making profits off of this. There are people who build these things, but they're really assembling component parts. And I think companies like Intel and Samsung are selling a lot of chips. There's just a lot of demand for computer hardware in this circuit from many of the classical vendors. But I would do some market research on exactly which firms. I've read, though, that many of the old computer companies that are very familiar names are finding.
Well, Intel just hit a 52-week high, or Intel's all of a sudden, and it hadn't even dawned on me that was part of it.
No, I would be surprised if they weren't indirectly participating in this by just selling raw material to many of the manufacturers. It's hard to build, in very large quantity, any computer machinery without Intel somehow having a foot in it.
So I spoke this morning, and after me at an event, and after me was this kid who's raised a ton of money, and he goes around financing crypto mines or crypto mining, and basically he roams the earth looking for the cheapest source of electricity,
Right.
and then sets up a crypto mine, and then I think sells the products or the equipment into the crypto miners. Are you seeing a lot of that sort of these like almost roaming nomadic businesses?
No, there's been some great news stories, and what you need is cheap electricity and cool weather so that you can buy the electricity cheap and then just open the window to keep your computers from overheating. So where's this going to be? Yeah, Iceland, in fact, is the #1 location, but northern Canada.
Isn't northern Canada the North Pole?
Yes, no, some of these things are above the Arctic Circle, but you're thinking tundra. And there is a lot of renewable energy, high winds and hydropower locally available.
This feels like an A&E miniseries or reality TV, not king crab fishermen.
No, this would be a
miners.
fun TV series about the life of a miner, because you're in difficult conditions, like those people who travel to the South Pole but can't really go outside. So there's probably whole soap operas that take place behind the scenes. But in the end, you're just trying to run computers at very high speeds without having them overheat. And it turns out that the optimum conditions for this are far from civilization. The further north you go, the easier the conditions become.
So last thing, Professor Yermack, and you're you reek of integrity and you don't like to make predictions, but I want to ask if there's any predictions you'd be willing to make. If Bitcoin end of year, do you see it, if you had to pick higher, lower, or the same, any gut for it right now?
My gut from day one has been that this thing is incredibly overvalued. I can't believe
incredibly overvalued.
Yeah, and I've been wrong about this. So don't take my advice.
But that's your gut. Your gut is it's overvalued.
Yeah, and I get asked all the time, how many Bitcoins do you own? And it's like 0. Are you kidding me?
Yeah.
This is really, really risky. It's hard to know if something's going to go up or down, but I'm pretty comfortable predicting that the ride will be a wild one, because volatility has been very characteristic of these assets from day one. And there was a period of a couple of years where the volatility was trending down, but in the last year it's exploded again. And I think that this is not for the faint of heart. I think that most of the coins you see in the market will go to 0, but that's also true of most of the stocks on the stock exchange. Sooner or later, it's a question of when. There will be a few, though, that are going to be very, very successful. And if people have the insight to identify those today, they are very good investments, but very hard to know what they are.
Even if crypto and Bitcoin isn't the success tangibly that we think it might be, isn't it likely we're going to see a major erosion in value among traditional financial services firms just because of the threat?
Yeah, and the blockchain technology makes many of the people who work in these organizations unnecessary. Blockchains are a real breakthrough in record keeping. They are a self-auditing ledger. So anyone whose job is keeping track of things, and this would be most auditors, most bankers, the people at the clearinghouse on the stock exchange, I think those jobs won't exist a generation from now.
So are you bearish on financial services from a valuation standpoint?
I would not be going long these firms unless you think that they will magically transition themselves into new modern organizations, but given the regulations they face, that seems very unlikely.
And does anyone stand out as being really aggressive around? I mean, they're smart people with a lot of capital. Someone told me Bank of America was turning into, a tech firm, that they are making huge investments.
They're trying,
this.
Yeah. I think they've gotten far past the denial. And even at JP Morgan, where the CEO said that Bitcoin was a fraud, there's an awful lot of blockchain stuff going on in the guts of the organization. But whether they can reinvent themselves quickly enough and whether the regulators will permit this, I think is an even bigger question. And I think what is likely to happen is that financial services will be encroached upon by people like telecom industry who can get into the payments business and already have, by media companies, by people like Google and Apple and so forth, who will, like vultures, pick off the profitable parts of the business and leave the low-cost, low-margin stuff for the banks.
And what's happened to our enrollments or applications for the fintech specialization at Stern? I think I know the answer.
Yeah, there's a lot of demand. We continue to add courses and look for new faculty to teach these topics. And we're just going through the course lottery right now for next year. But I'm offering 2 sections of my course instead of 1, which it's been up till now. And I think we'll be adding more and more courses.
And the demand is there? Recruiters want to hire these kids?
Yeah, and Still, it's a lot of the old firms, though, they're looking to hire in these new wildcat divisions. So, JP Morgan may be recruiting software engineers and big data people as opposed to MBAs. But the recruiting profile has changed. That our biggest recruiter today is Amazon.
Yeah.
And it used to be Citi.
14 kids in my class Tuesday night. 14 kids are going to Amazon.
And Amazon, if they're not thinking of themselves as a finance company in some way, shape, or form, are missing the point. I'm sure that they're...
Yeah, but what aren't they? What kind of company aren't they at this point? Professor David Yermack, head of our FinTech specialization at NYU Stern and chairs the Department of Finance at Stern. Thanks very much, David.
Thank you, Scott.